Market's up huge. I think it's up over 1%. And here, I'm the idiot out on a limb saying, I don't think this is something you should be buying. I think it's something you should be selling for all the reasons I just mentioned. So the Fed's going to go to QEs, or gold might have a little hiccup as it's sold for liquidity, and then you'll never see those prices again. Michael Pento has predicted the end of the world. I'm saying that there's an incipient liquidity issue. It could be secular, protracted in nature. I'm getting more defensive now. That's all I said. I'm still long 15%, but I've got lots of hedges. I've got precious metals in there. I'm shorted the long end of the bond market because I don't see any upside from here. And even then, I'm gonna tell you that even in a recession, that who's gonna buy $6 trillion of an annual deficit? Who's gonna do it?
In today's news recap, silver hits fresh record after topping peak from October squeeze. Silver jumped to a record, surpassing a peak set during a historic squeeze in the London market in October. Spot prices surged as much as 4.2% to about $55.66 an ounce. The white metal has been supported by rising hopes of a Federal Reserve interest rate cut in December, inflows into bullion-backed exchange-traded funds, and ongoing supply tightness. Friday also saw erratic price moves and thin liquidity in the silver market after a chaotic hours-long halt to trading in futures on the CME's COMEX exchange. By early morning U.S. time, most trading operations were back. Silver's new high comes just over a month after a severe supply squeeze in the dominant silver trading hub in London last month, which sent prices soaring above levels in Shanghai and New York. While the arrival of nearly 54 million troy ounces has eased that squeeze, the market still remains markedly tight, with the cost of borrowing the metal over 1 month hovering above its normal level. The flows into the London market have now put pressure on other hubs, including in China. Silver inventories in warehouses linked to the Shanghai Futures Exchange recently hit their lowest level since 2015, according to Bourse data. In the short term, a further price increase cannot be ruled out if registered silver inventories in China continue to decline, analysts at Commerzbank AG wrote in a note earlier Friday. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
I was bearish at the start of this year, primarily because valuations were not only off the charts, but they were... The market as a whole was entering a period of time where I would see growth slow. And that was primarily because of the border closures. So you'd have half of the input to GDP was going away. So I was bearish, not overly bearish, but it was negative, net negative on the market at the start of the year. And that was borne out, after April 2nd, and then I turned bullish in May. So I've been bullish in the market from May until 2 weeks ago. I'm getting there. Just I have to give me a little bit of a rope here to hang myself. So, as they say, so I'm now, much more bearish than I was before when I last came on your program. I think I was 40% long, and now I'm only about 15% long. So I'm not saying that the world is going into a global liquidity crisis or we're having a crash in the markets. What I am saying, what my model is telling me to do is to become a little more cautious, even though, this is the bad time of the year to do that. November, December, some of the best months of the year, calendar speaking. So let me just tell you what. So beyond the obvious, where we see high beta sections of the market crash. So you think about, the AI trade, Bitcoin, some of the more speculative metals that saw a lot of flows in, they've all corrected sharply. In fact, I think Bitcoin is down 30% now from its high, and down about 7-something% on the year. So It's pretty significant. So beyond the fact that the market is telling me that there's some liquid stress in the high beta sections of the market, then I ask myself, I turn to my model and say, is this a correction which should be bought? Or is this something that I might have to worry about? So let me just tell you four things that I think that there could, and that's now, again, let me caveat, I'm not saying sell everything. Michael Pento is now panicked about a credit crisis and a recession. Didn't say that. I said it's prudent to take some risk off the table. I'll tell you some things that I'm worried about. So number one is the yen carry trade is under a lot of pressure. I think I'm one of the one or two people that's even talking about this, but just to quickly refresh your memory and your audience's memory, yen carry trade, you borrow in yen for 0%, and then you go out around the world and say, sell the yen, buy other currencies, and buy their bonds, and it's like a risk-free. You buy their sovereign debt. Like the U.S. is yielding 5%, and the yen is the JGBs are yielding 0. And you pocket 5%. Then you have the currency translation and all that whatnot. But it's a free trade, and you lever that trade up many times over, and that money goes into the bonds, it goes into the stocks, it goes into the dividend stocks of domestic equities. So you understand. So, and then what happened is that the Bank of Japan unleashed a massive stimulus plan. And the administration of Japan, the new prime minister of Japan, I'm not going to pretend that I can say her name actually. I'm not even going to try. But anyway, the point is that the yields in Japan started to rise. The benchmark treasury went from near 0. It was 0 for a very long time. Went from 0 to 1.8%. So, and our bond yields are coming down, or at least staying pretty much where they are. So, on the not the short end, on the long end. So you're having a compression in that trade. So that's pressure on the yen carry trade, and that less liquidity in the market. Then you look at the reverse repo facility, which was once $2.5 trillion. It's now effectively 0. That's the excess liquidity. Think of that excess reserves the banks don't need. They park it at the Fed. That's all been taken out of the Fed, was laying fallow at the Fed, that credit, and went into the bond market. And that, that's it was like a QE. But that's over now. That's done. Then I look at bank reserves, the actual bank reserves in the system. That is down $1.2 trillion from where it was in 2021. Those are banking reserves. And then, finally, the fourth thing is I look at the real Fed funds rate, which for the last 2.5 years has been in positive territory. And just going back to the last couple of recessions, whenever you see a positive, and please don't write me letters. I mean, I understand they lie about inflation, but at least it's keeping the metric consistent. If you subtract the real Fed funds rate from inflation, you're at a positive level. And that's and just using their bogus methodology going back decades of how they measure inflation. And the Fed funds rate is obviously just, you can't lie about that. It's what it is what it is. So for those 4 reasons, I've witnessed in my model, financial conditions stop tightening, and that makes me believe that there's a real issue here. It could be the incipient, the very beginning start of could be a credit crisis, but at least it's a significant enough liquidity drain for secular reasons that I need to protect my clients. So if you look at high yield spreads, you look at financial conditions, they're making me get a little more defensive in the portfolio. Sorry for the long answer, but that's the whole picture.
In today's news recap, gold heads for 4th monthly gain, silver hits fresh record high, spot gold rose 1% to a 2-week high on Friday as expectations that the Federal Reserve will trim interest rates next month lifted demand for the non-yielding asset, while silver hit a fresh record high. Spot gold rose to $4,192.78 per ounce, its highest since November 14th, and was set for a 2.9% weekly gain. Bullion, set to register a 4.6% rise this month, is on track for its 4th consecutive monthly gain. Silver climbed to a fresh record high of $55.33 per ounce, up 3.5% for the session and 13% for the month. The expectation is that we're going to continue to have a slower economy going into 2026, and the Federal Reserve is very likely to cut rates, which is getting some investors back into gold, said Bart Melek, head of commodity strategies at TD Securities. What do you think, you guys? Are gold and silver set to soar in 2026? Gold tends to do well in low interest rate environments. Recent dovish remarks from Fed Governor Christopher Waller and New York Fed President John Williams, combined with softer U.S. economic data following the government shutdown, have strengthened expectations that the central bank will cut interest rates next month. Traders see an 89% chance of a rate cut in December, up from 50% last week. Meanwhile, the technical charts for silver have turned more bullish in the past week or so, and that's inviting the chart-based speculators to the long side of the silver market, said Jim Wyckoff, senior analyst at Kitco Metals. Gold demand was subdued across major Asian markets this week as high prices curbed retail buying even as India entered its wedding season. In China, the removal of a tax exemption on gold purchases dented consumer appetite. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
And that's very low. So I'm not saying the end carry trade is over. I'm saying there's pressure there. That's all I'm saying. And it's one of the four reasons why I'm starting to see financial conditions stop easing, why I'm starting to see credit spreads start. And this is incipient now. That, me being a nervous Nelly, I don't like losing money. So if it was just that Bitcoin was crashing and couldn't catch a bid, and AI stocks were falling, I would say, well, maybe this is just a healthy correction that should be bought. But then when you marry that with the four things I just mentioned, and its effect on liquidity, and you say, wait, this could be systemic. This is something that I have to protect my clients from, just in case it turns out to be what I think is coming anyway, eventually.
One of the things you did not mention in your list of reasons for caution, reasons for concern, was insider selling. We've seen record cash position ever in the history of Buffett being raised, and also in George Soros's investment hedge fund, and obviously it's like 6-to-1 or 7-to-1 insider selling this year by even those of the high-flying Magnificent Seven. Is that factoring in at all? Does insider trading factor into your model at all?
No. Well, because it doesn't, because it doesn't affect liquidity. So everybody who sells something, you get a buy on the, it's a buy and a sell and it's a match. So it's not, if the reverse repo facility is drained, that's fallow money. That's like a QE program. The yen carry trade, it's new money printed by the Bank of Japan. Bank reserves. The only way you can lower bank reserves is only two ways that I know that bank reserves can get drained is by quantitative tightening when the Fed does it, or if there's a demand for cash. People go to the bank and say, I need cash out. Well, that drains reserves from the banking system. Not a run on the bank, but bank runs drain reserves. Well, reserves are dropping. They're actually dropping pretty precipitously at the last I looked at it. They're only reported on a monthly basis. So, but their reserves are down, as I said, 1.2 trillion from the high. So, the real Fed funds rate being positive, it acts as a drain on liquidity because there's a real cost in borrowing new money. So that's why listen, do I think it's inconsequential? No, it's an ancillary, function of this liquidity issue that you would see insider sell, but that doesn't directly affect liquidity. So the answer is, my model is built to detect when I would see the handful of, the oligarchs, I'll call it the plutocracy, whatever, the people who actually run this planet, their insider buys and sells and shorts is what I want to know. I want to know what they're doing. That's what I built my model on. So I see their footprints before before the moving average blather that you hear on CNBS. I mean, that's just, listen. Tell me what the second derivative of inflation is, and tell me what where growth is, and let me monitor my liquidity model, and I'll tell you where I think. I tell you if I think we have a problem or if we don't have a problem. I mean, if you have a liquidity crisis or a recession, you're going to have a big problem in the stock market because you're starting from a point where it's, 220% of GDP, which is total market cap of equities. So the valuations are, the fact that we're in a bubble is indisputable. It's not my opinion. It's an absolute fact. It's an absolute fact. I mean, if you look at every single metric that you want to look at, price to sales, Shiller PE, trailing PE ratio, 10-year PE ratio, total market cap of equities to GDP. I mentioned price to sales, risk premiums being negative. There's a myriad of metrics you can look at. And this is not just something that's expensive. It's incredibly, humongously expensive stock market. So this is gonna reconcile itself in a very dangerous way because you can't point to me one bubble in history that has bursted innocuously. It just doesn't happen.
What do you think of his take? Do you agree with him? Is a major melt up in gold and silver going to happen in 2026? Are you buying more gold and silver in Black Friday? Share with the stackers your strategy in the comments section down below and watch this video right here because it's a perfect fit for you. I'll see you on the other side.